All right, let's see how this works in other markets. This is the SPY and the SDS. Let's take a look at the diamonds, and it's opposite the DOG, which is the short ETF for the Dow Industrial Average. And basically, you're going to see the exact same pattern, a little bit different because they are different ETFs and they're measuring different basket of stocks. But you've got very, very similar patterns. Now remember, we're following the patterns. We've got lower volatility on the DOG. We've got higher volatility coming into the diamonds. And when that happens, look what we're doing now with the diamonds. We're getting high volatility and we're getting low volatility in the DOG. So it's important to keep an eye on that. And what I found to be mostly true is that this rounding pattern both in the short ETF and the volatility at the top in the long ETF, when you see that pattern, this rounding, lower volatility in the short and the higher volatility kind of topping process, rounded topping process in the long ETF, that's a time to start paying attention to a change in the market. Let's take a look at the Qs and the PSQ. The PSQ is the short. It's a little bit more volatile. It's not quite as simple as the diamonds or the SPY. There's a lot more volatility in the NASDAQ issues. But you can see that the spread is starting to widen to the point, and we're getting a huge amount of volatility in the Qs now after having very low volatility. See, here's the clue that you were looking at for the Qs in the early part of the end of 2008 and early part of 2009 was the lower volatility in the Qs and the higher volatility in the PSQ, the short ETF. So you can see how the higher volatility here led to a decline in the PSQ. Lower volatility confirmed the high volatility change and trend for the PSQ, and that it could have gone along the Qs at this point, giving you a tremendous amount and a huge advantage in the market by being able to identify low volatility and high volatility in these issues. So if I was to share with you a single the most promising, the most dramatic, the most interesting, and the most profitable and the safest way for you to trade, that is to identify, as I've said throughout this entire course, how to identify low volatility and high volatility environments. It's absolutely critical for your trading to understand how to take advantage of low volatility environments and how to identify when you're going from and transitioning from a low volatility environment to a high volatility environment, and when you're transitioning from a high volatility environment to a low volatility environment. For the last 100 years, this has been absolutely true, and maybe even longer. My studies go back as far as 1900 in the Dow Industrial Average, and when you start to enter a high volatility environment in the Dow, after the market has had a substantial rise, generally you're going to get a substantial pullback. And when you have a high volatility environment, and all of a sudden those bars start to get narrower and narrower, and you start to see lower volume coming into the market, and lower the bars are not as wide as they used to be, and they start to become rather small and diminutive. At that point, you understand that low volatility is starting to come back into the market, and there's a good chance after a long and protracted decline that the market is ready to turn around and go higher. Identifying what environment you're in the market is absolutely crucial for your success, and understanding what happens during low volatility environments and high volatility environments and how to trade each of those types of environments is what we taught in this course. And I really hope that you've got a tremendous amount of information out of it, and I hope it's going to help your trading not only be safer because you know when the market is about to turn down or when it's going to go up, but also how to trade profitably and what instruments to use. Remember, it's absolutely critically important that you when you're buying or selling options, they on the surface it seems like it's a very easy proposition. And I know a lot of people and a lot of traders who enter into very complicated trades and positions and spreads and so forth, and those kinds of trades can make money. But the market changes on a regular basis, and you need to keep up to date on where the market is going to be. For example, certain spread strategies work very well when you're going from a high volatility environment to a low volatility environment, and you need to be able to understand how to take advantage of those profit opportunities. For example, in a high volatility environment, and you know you're going into a lower volatility environment, what happens to option prices when you're in a high volatility environment? As we stated in the beginning of the course, those option premiums expand dramatically. They become very large. So that's a perfect time to sell options when you're in a high volatility environment. You want to put on those types of spreads in which you're gaining option premium from the sale of options going into a lower volatility environment, so that those premiums decline dramatically as we get into a low volatility environment. And what do you want to do when you have a low volatility environment and you're going into a high volatility environment? Remember, premiums on options expand dramatically during that time. So you want to purchase options at that time, purchase puts in the money puts, at the money puts, depending on what your timing is going to be. If you think you can time the market absolutely perfectly, there's no reason why you can't buy out of the money options, and as those premiums expand dramatically, get out at that point. So recall and go through this course again, because I put a lot of information in here that you may not have picked up on the first time around. Make sure that you go back to the beginning and review those studies again of understanding how options react in low volatility environments and high volatility environments, and remember how all of the Greeks of the options affect the price of those options. So you take a look at the delta, you take a look at the vega, which is the most important. Take a look at the at gamma, and finally take a look at theta. In all of those factors that affect the option prices of an option, you understand, you have a good understanding of them, probably better than 99% of the traders out there right now. You are in the top 1% if you understand how volatility affects your positions, how understanding when volatility is coming into the market and when volatility is being taken out of the market will give you a much higher chance of success than just about anything else that you can study. Know what kind of environment you're in, and then pick your trading instruments appropriately for the trading environment that you're in. I wish you all the best of success and safe trading and profitable trading for many years to come. This is an evergreen course. In other words, the principles of volatility are not going to change. Over the past 100 years, the study period that I've used for this course, these principles have held true, and I believe they're going to hold true for the future. And I wish you all the best and success.